Hi everyone, this is Craig, the Options Linebacker. This is the weekend report for Sunday, September 26th. What I'm going to start off with today is what I call a tale of two charts. Let's take a look. This is the daily chart of the S&P 500, and what I'm showing here is going from the late April top all the way till the early July bottom here, and you can see that this clearly was making lower highs, lower lows all the way through this price action. So we have a clear downtrend and a certain correction off of the cyclical bull that started in March of 2009. Now this move also had the potential to be the beginning of the second phase of that secular bear market that we've been in really since October of 2007, if not earlier. So now the second chart is of the S&P since that point in early July, and you can see that we've been making essentially higher highs and higher lows through this whole time. So we've been in a primary uptrend essentially since early July, although I know it certainly doesn't feel like it. The major point here is that when this higher low was put in at the end of August, that was a major turning point in the market. At least so far, that's what the price is saying. Now the bulls are not totally out of the woods just yet. Let's go to the monthly chart here. We can see that we're going in a primary downtrend right now because we went from a higher high to a lower low back in March of 2009. So far, we have a lower high in the monthly chart. So that's a clear downtrend that we have in the monthly chart. However, if the chart can start to put in some higher highs and higher lows, that will tip the scale back over to a primary uptrend. What will be required for that? Well, right now we have a lower high. We do have a higher low, so what we need to see is the market starting to print on the monthly chart higher highs and higher lows. A close above S&P 1220 would be a good thing to see. Then we can start to say that we've had a change of polarity back to an uptrend. All that shows is that that cyclical bull is still in force, and the fact if we do get a close above this level at 1220, that shows that the 61.8% retracement has been penetrated. Normally what you see is when the price closes above 61.8, normally you fill in the entire triangle. So we could be back to those prices again, although this is a little early to say that. Let's go down to the weekly chart to show a little bit more detail about what's at stake here. Here's the weekly chart. We had a very classic 5-wave series up off the bottom. And everything played out almost perfectly because the wave 3 in the middle was the longest of the 3 waves, the 3 impulse waves that we had. And wave 5 was kind of a parabolic move to the upside as people chased after it and fund managers held their nose and bought the dips. All in all, a very classic 5-wave series to the top on that cyclical bull from March of 2009 through late April of this year. Since that point, what we've seen is a very scary and very emotional ABC correction, but it's only gone back to the 38.2% rally. For all of the bad news and all of the fuss and commotion that we've seen over the last few months, which has included a huge shock over in Europe as to whether countries are just going to basically default, as well as the fact that we could see growth numbers starting to come in. We had some pretty good growth numbers showing a recovery, but we could see that that recovery was for the most part stimulated into being, and we were saying, okay, is there any organic growth at all as we got into the spring this year? So you have to say, for all those fundamental negatives about the market, the only thing it's been able to do to the downside is a very common garden variety 38.2% retracement. Since the fact that the market digested all of that bad news, look at what's happened since then. We've had that primary uptrend kick into play, and really, again, this was the important thing, that higher low set up here. On very, very negative news, the sentiment was just about as negative in late August as it was all the way back in this period here. This is why the wall of worry gets built on things like this, because we have short memories. We remember these days back here in the fall of 2008, just 2 short years ago, all too well. It scares us to death, and we think that there's going to be a sequel coming out, but this is all that the market has been able to do. The bottom line here is it appears that the market has already digested all of that bad news, and we're unwinding again to the top side with short covering. So as we go back to the daily chart, what the chart is trying to tell us right now is, especially after this very complex low that thrashed out a bottom at this point and formed a higher low here on the weekly chart, we've just been gapping straight up since then, with the market not bothering to close those gaps. Even the pullback that we had just this week was very overdue, because we rallied 10.5% really in the space of just about 2 weeks. So we did get finally a pullback, but it was just a very short, sharp pullback with an extremely strong day on Friday where the bulls bought on relatively bad news again. That says to everybody that, look, we've priced in the worst already. The only place that this can go is to the upside. Now, the market is certainly overbought right now short term, but that never stopped the market before. We can see that we've had these types of rallies where we've had a melt up, the market's been overbought, and has essentially recharged as it's gone up. So what we might start to see is it slip into, if it is going to go up from here, kind of a grinding motion to the upside where it just sort of melts up day by day by day. Believe it or not, that type of trend will actually recharge itself on the way up. It does not require a dip back down, pull back to support to attract new buyers. Here's what I'm going to say in the short term is that the chart to me is bullish as long as it stays above S&P 1120 on the cash index. And if it goes down below that 38.2 retracement, which is going to be below the 200-day moving average, and goes down below S&P 1100, even though it's still above that 61.8% fib, this is the time where the bulls can really make some hay. They've got the bears with their backs to the wall, and if they can't execute a short squeeze right now, they never will. I'm going to say the chart is bearish if the cash price goes below S&P 1100. Now, September has typically been at least what those in the Traders Almanac say, a terrible month in the marketplace, as fund managers get rid of their turkeys and position themselves for what usually is a fourth quarter rally. See, I don't know if I really believe in this conventional wisdom anymore. I think a lot of that has been pushed back lately. We've seen some late summer rallies that have continued through the fourth quarter. So nobody wants to miss it, so they get it started early. So let's go back over the last few years and see whether or not we have any tape painting into the end of September, which is the end of third quarter. Okay, you can see the month of September here in 2009, and pretty strong move up off the bottom, but over the last couple of weeks there was actually a little bit of a corrective pattern. So in this case, no tape painting into the end of the quarter last year. I think 2008 was pretty obvious that we didn't have any tape painting into the end of the quarter. Now in 2007, this wasn't really fair because we had such a huge move off the Fed day where the Fed actually started to cut rates and pushed it up early, but we did have some late movement into the end of the month. So I would say we did have some in 2007. And if we go back to 2006, we had generally a very bullish move up off the bottom, but certainly no strength in the last couple of days here. So based on just the last few years, we can see that the pattern is, there is no pattern, because what's supposed to be a bad month has typically been, for the most part, through most of these years, fairly bullish to the upside. So September is supposed to be a bad month. There's no pattern there. So take your Traders Almanacs and throw them away. The second thing that we're seeing here is there's not really any pattern as far as painting the tape or pushing up assets to make them look better just before the end of the quarter. Okay, folks, that's it from the locker room. So know your ranges, know your entries and your exits, and follow your trading plan. We'll see you next week, folks. Take care.